Thanks everyone for joining us today. My name is Taylor Pierce. I'm Senior Economist of OMFIF, and it's a pleasure for me to walk through the 10 key findings of this year's report with you. To start off, I just wanted to give a bit of background about the report. So as Mark mentioned, we were pleased to survey 75 central bank reserves managers this year for the survey. That includes both advanced and emerging economies from across all 7 continents. The total international reserve assets of these institutions total $4.9 trillion US, which is approximately 1/3 of all international reserve assets. In addition to the survey, we also include extensive data and analysis of 171 central banks around the world, ranked by their reserve assets, including some regional breakdowns as well. So be sure to check that out in the report, which will be available to download at the end of this presentation. But for now, I will come to the 10 key findings from our report. The first key finding is that reserve managers have had a tough year. As you can see, also mentioned by Frank, total international reserves fell from their peak at the end of 2021 from $15.7 trillion US to $15 trillion last year. This was due to a combination of valuation effects as well as FX intervention in the face of market volatility. It's important to note that reserves fell in every region around the world, apart from the Middle East and North Africa, and this was mostly due to higher commodity prices last year. But overall, we see an unwillingness, or in some cases, an inability for reserve managers to continue to intervene. So when we look specifically at what is concerning reserve managers this year, we see that stagflation is the primary concern. We asked the reserve managers that we surveyed, what are the 3 most important factors affecting your reserve management operations in the current macro environment? Inflation was about the same share as last year. As you can see here, 85% list inflation as one of their top 3 concerns. And not a single respondent stated that they expect inflation to be reined in to the 2% target or under in the next 2 years, which is quite striking. In addition to inflation, we can see here that 70% list global economic slowdown in their top 3 concerns, which is more than double the share listing this as a top 3 concern in 2022. Additionally, 38% of those we surveyed expect a recession this year. So as you can see here, it's quite a difficult macro environment for reserve managers. And another factor which is included here in the short-term concerns is geopolitics, which has actually fallen as a short-term concern compared to last year. However, we see that over the long term, geopolitics and geopolitical tensions is now the #1 concern among reserves managers. 83% list geopolitics and geopolitical tensions in their top 3 concerns affecting their reserve operations over the next 5 to 10 years, so a longer-term time horizon. This is what we saw from some of the survey comments was that reserve managers are particularly worried about US-China tensions and decoupling there, in addition to the fragmentation of trade and capital flows. Other long-term concerns include inflation, which we can see here. Again, not expecting that to be reined in anytime soon. And climate change ranks as #3, but does seem to be taking a bit of a backseat in the face of more acute concerns like inflation and recession. Given this difficult macro picture, the next key finding is that we see that it will be a long road to recover the losses which central banks suffered this year. 80% of the reserve managers which we surveyed experienced losses on their portfolio this year. And as you can see from the pie chart here, around 40% expect that it will take 1 to 2 years to recover these losses. And an additional almost 25%, the gray bar here, expect that it will take 2 to 5 years. So all in all, nearly 2/3 expect that it will take over a year to recover the losses suffered in 2022. This also is in line with another one of our findings that capital preservation was the #1 investment objective of reserve managers this year. We also find that very few are taking on more risk as a strategy to plug some of the gaps from these losses. And this cautious approach is also evident in our asset allocation findings. Traditional reserve assets are in demand this year. So just to explain this chart, the light blue bars indicate the share of survey respondents looking to increase their allocation to the following asset classes, whereas the dark blue bars represent the share looking to decrease, and the gray diamonds are the net share of respondents. We can see that a net 32% are looking to increase their share, their allocation to government bonds, which is by far the most popular asset class here on the top. That's followed by net 20% looking to increase their allocation to quasi-government bonds over the next 12 to 24 months. And this is due to a higher yield in fixed income assets, as well as a flight to safety dynamic, which is also seen here as gold is the third most popular asset class for which reserve managers are looking to increase their allocation to. We also see less demand for equities, asset-backed securities, real estate, and corporate bonds than we have seen in previous years as well. So riskier or alternative assets are not as in demand. And this risk-off sentiment is something we also see in our currency allocation findings. We see this year that reserve managers overall are cautious on the renminbi over the short term. We see here that the share of respondents looking to increase their renminbi holdings has halved, falling to 13% this year from just over 30% last year. When we asked what some of the factors are that might be obstacles to further increasing holdings on renminbi, we see that market transparency and geopolitics are some of the main barriers, which could prevent reserve managers from increasing their renminbi holdings. However, over the long term, we do see that there is higher demand for the renminbi than for any other currency. A net of approximately 40% are looking to increase their allocation to the renminbi. And this shows that the renminbi, despite some short-term challenges, is going to be key for longer-term currency diversification of reserves. So related to this rise in the renminbi over the long term, we also see a gradual and marginal decline in the US dollar as a reserve currency, but we do see that it will still remain the dominant reserve currency. So we asked reserve managers what they expect the share of global reserves will be for the US dollar and the renminbi in 10 years' time. Those estimates are represented here by the dashed lines. And we found that on average, reserve managers expect that the US dollar will fall from the current approximately 60% of global reserves to around 54%. And the renminbi will rise from its current 3% of global reserves to around 6%. So these are increases and decreases respectively, but we do see that the dollar will still remain dominant and increases in the renminbi will be marginal. In the meantime, we also see that the euro will benefit from currency diversification. No other currency over the short term has a higher net demand. So again, the gray bars represent the net share of survey respondents looking to increase their allocation to these currencies. And a net 14% say that they will increase their euro holdings in the next 1 to 2 years. Additionally, 9% are looking to increase their share of the euro over the next 10 years, which is a longer time horizon. So we do see the euro playing a key role in diversification away from the US dollar, especially if the renminbi doesn't seem like a viable alternative. Staying on Europe, but moving now away from our asset allocation and currency findings to our ESG findings. We see that European central banks have the strongest appetite for sustainable assets. And this is across all sustainable asset classes here. As you can see, European central banks are represented by the light blue bars. We see that green bonds have the most interest are of the most interest for reserve managers, with overall globally 40% of survey respondents looking to increase their allocation to sustainable assets in the next 2 years. And European central banks, the share is even higher, with 61% looking to increase their share of sustainable assets in the next 2 years. So sustainable assets and investment in ESG assets is definitely an area to watch. We anticipate that there will be much more interest in the future. This isn't going away anytime soon. And there's a lot more data on ESG in the report, so be sure to check that out as well. Moving now to the final key finding, we include a new section in our report this year on data and operating models. We asked reserve managers, what are your main operating challenges? And we found that talent was the main issue, where with 58% of survey respondents reporting recruitment and training as the top operating challenge. We also asked a few questions on external management of reserves, and we found that external managers may be used to fill this gap to some extent, with the vast majority of survey respondents, 74%, reporting to use external managers, and knowledge transfer and access to complex asset classes being the primary reasons why external managers are utilized by reserve managers. So that concludes the findings. And just to wrap up, we find that reserve managers this year are challenged with losses, stagflation, and geopolitics, very pressing concerns over the short term and long term. We see signs of a flight to safer assets, including government bonds and gold. On currency, we see that the US will remain the dominant reserve currency, while the euro may benefit over the short term from diversification strategies. And allocations to the renminbi will rise, but the shift will be small and gradual. That concludes the key findings presentation. Thank you very much for your attention. Please take a moment to download the report via this QR code here.